After a difficult 2018, China stocks have bounced back more than other markets, and hedge fund Tudor Investment Corporation, founded by US billionaire Paul Tudor Jones in 1980, is one of the many funds who have bought back in. Pessimism over the outcome of the US-China trade dispute and the general health of the economy turned out to be over-exaggerated. In fact, a bet on a resurgent Chinese stock market has been one of the best trades of the year so far. The trade received a boost when President Trump stated that they would delay an increase on the tariffs to be placed on $200 billion worth of Chinese goods, following substantial progress made in trade talks. Another US fund to have benefited from the trade is New York-based Key Square Capital Management, founded by Scott Bessent, the former Chief Investment Officer of George Soros's family office. Positioning themselves in recent months to benefit from the rebound in Chinese stocks, Key Square, which has $5 billion in assets under management, is up 8% this year, with much of the gains coming from its bet on China. The CSI 300 index of companies listed in Shanghai and Shenzhen, which fell 25% last year, gained 5.9% last week, and despite losing some ground, is still up over 20% for the year. The jury is still out on the actual true state of the health of the world's second biggest economy, which has seen growth in the fourth quarter slow to its weakest pace since the financial crisis. However, some other indicators have been more positive. Those who remain bearish on China point to the news that a Chinese state-owned enterprise has failed to repay a US dollar bond in Hong Kong, the first offshore default in 20 years. Bulls, however, look towards potential further stimulus by the Chinese government to help prop up the economy. The winning trade has come at a difficult time for hedge funds, many of whom have struggled over the last few years to beat the index, betting the wrong way on moves in global bond, currency and stock markets. Hedge fund performance has in reality declined significantly since the 1990s, although assets under management have continued to rise. Whereas in the 1980s and 1990s, it tended to be wealthy individuals who were the original hedge fund clients. Now, large institutions have become heavily invested, even as alpha has fallen. It's not, of course, completely the fault of the manager, with new institutional clients demanding higher risk control. Hedge fund managers became willing to give up performance points in order to achieve the low volatility that was so important to their institutional clients. Positioning for a rising US dollar and higher US bond yields, which they expected to lead to more trading opportunities, traders were taken aback by the about turn made by the Federal Reserve in their interest rate policy, putting further interest rate rises on hold and stating that they would be changing their balance sheet policy if necessary.